We're starting in just a couple of seconds.
Just put the camera on for a short while, Colin, then you can see, get some context.
That's okay. Right, welcome everyone. I'll be checking the screen just in case anyone late joins. Yeah, just wanted to really, obviously, when in the world of not meeting people, I think it's important for businesses to ensure that we still stay in contact, and in some respect, the technology allows us to join people that otherwise would not otherwise be able to join where we're based. So I was going to run through, first of all, I've chosen one subject for the Q&A, and then, but it could be over in 10 minutes. It could take the whole hour. I'm open to for being butted at any point if anyone wants any questions answered, or we'll have the general questions and answers covering other tax areas after my short presentation. And before we run through what I was going to cover, perhaps we can just run through the individuals that are attended today. So if you'd just like to introduce yourself and what your interests are, it enables me to make sure that you're getting the right kind of information and it's not completely irrelevant to you. And if it is completely relevant, then forgive me, and you'll have to join at the Q&A section at the end, or for that matter, join another time. I am looking to hold regular sessions of these. So first of all, just in the order of the order that I've got them on here. So Cumney, would you like to just introduce yourself to?
Good afternoon. My name is Kumi. I'm an architectural visual designer, so that entails doing architecture drawing, 3D rendering, and that sort of stuff. The reason why I joined today was I saw Colin was on our Clubhouse this morning, and I realized that you said you'd be doing this session. So really what I wanted from the session was to understand, I'm trying to get into property myself, rent to rent. So I was looking to ask for advice on how to structure like my business and how to go about it really.
Okay, fine. So if we can just run through then, Bala, can you just briefly cover your interests and what you're involved with?
Could you hear me? Could you hear me?
Yep.
Yeah. Hi, Colin. Thank you. I also saw you in the Clubhouse in the morning, which is great. My interest is in setting up a private limited company in buying properties, either HMOs or service accommodation or rent to rent, to understand the structure, and also the exit of when you want to sell in the future. Yeah.
Okay. Thank you, Mike. You mentioned you think it wasn't so relevant for you, so will you just explain what business you do and what's your?
Sorry, I don't remember saying it wasn't relevant for me. But, I don't know when I said that, but
did you want
sorry,
to introduce yourself to? Yeah.
Sorry, yeah, my name is Mike Litting. I run a small accountancy practice as part of the Certex accounting franchise. I'm based in Lichfield. I've not attended one of your sessions before. We've not met or spoken before, but obviously we connected on LinkedIn at some point, and I was just interested to listen and pick up any information that I can that might be useful.
Yeah, I mean, from that point of view, one of our specialist areas is property, and we do look after a number of accountants that have their own practice, and we just obviously cover the speciality that they don't do, and they still serve the clients. The clients are completely unaware who's covering some of the aspects of their work, and then sometimes it's well beyond what someone wants to cover in the first place, and then they just pass it all over to us. So we're happy to work on on a collaborative basis. That's not a problem.
Okay.
Okay. Just omitting a couple of more that seem to drop out. So next, just introduce yourself is what of course is Hermine. Am I pronouncing that right?
Hi, it's Hermione. Yeah, or you're welcome to call me Hermione. Many people do. My interest is I'm also an accountant actually. I'm actually in financial reporting on the property side. So I'm actually a specialist in lease accounting. But my interest today specifically is actually more on a personal note. My husband and I are looking into starting to buy to let really. And so, yeah, it will just be good to broaden my knowledge on the tax side of things with regards to property taxes. Yeah. Thank you.
Okay, that's great. And Peter, would you like to introduce yourself?
Yeah. Okay. So we have 3 buy-to-let properties, a couple overseas. The overseas ones were started late in the 2000s, so they're probably about 13, 14 years in. The expectation is or was that we might see some capital appreciation. That hasn't actually materialized. But our logic at the moment is that they are producing an income which is more than you can get anywhere else reasonably. And I suppose my interest today, Colin, is to sort of see where we might go with those, or indeed, as Mike said, maybe it's time to think about exit strategies. Sorry, was it you that said that, Mike? Maybe not. No, okay, sorry. Somebody said that. Bali, yeah, Bala, sorry. So, yeah, that's me briefly. I'm not sure, therefore, how relevant this is, as I mentioned earlier, but you don't know where things might lead.
Sam, do you want to go next, please?
Hi, Colin. Forgive me, I had technical issues earlier. I had to drop out and come back in. I hope you can hear me now.
Yes.
Afternoon. Thanks for putting the session together. I joined because I heard you talking in a clubhouse meet earlier today, and I thought it was interesting because I'm thinking about what to do when it comes to buy-to-let. I already have a buy-to-let property on a personal side of things, but thinking of doing something else. So I'm probably your catchment in terms of thinking about what are the considerations. So I'm here to learn and take any new information that might help me make my decision.
Sure. Okay, and I think that's called everyone. We did have 2 more that joined, and I think that's everyone that we've caught at the moment. I've just also let you know that technology's fine, but I've also got broadband issues today. I've not had experienced it for some time, although I do live in a rural part of Hampshire. It's not normally this bad. So I have made Mike a co-host just in case I was to drop out. So moving on to myself, for some people that haven't met me or haven't met me for a while, yes, as well as specialise in looking after property investors, businesses, I also have, since 2002, I think it is, started buying my own properties. I think my story is possibly different to other people's, in that my ex at the time wasn't so keen on buying our next house, our next family house. So I had a degree of cash available, and I wasn't prepared to just leave it in the bank. So that was the basis behind my initial 2 investments. And obviously I got the bug, and it spread from there. Possibly bug in a big way, because property number 3 was actually a batch of 6 properties, and then on the same month I actually bought my building that I currently still work in, obviously not today, but has been a basis to my business home for those years, and I've expanded since then, obviously, to property wise. We look after clients' properties. I've got quite a lot myself. And we also look after and have acted upon and supported anybody across everything from foreign investments, builds, developments of all shapes and sizes, but it's still very much focused around the individual and the investor that my client base is based on. So whilst some of them are in the tens of millions, there's still very much individuals that are running it. So I don't run it around corporates. So I can offer something more than just purely the tax advice and the accounts, because I've been doing it myself. So I wanted to run initially just 2 sessions and see how these go. One on CGT is the next one, which is going to be an issue for potentially for the next budget. And I wanted to initially cover an area which is very important for a lot of people, because they've either just paid their tax bill or they're calculating their tax bill, and it's on the subject of how you should incorporate, or should you buy another property, would you buy it as an individual or as a company. So for I'll do a quick screen share. In fact, what I'll do is, rather than doing a screen share, I'll share you the link to the website that's got the article on later on, so you can then digest it in your own leisure. It's currently not linked from our main page at the moment, so that's going through things. So essentially, you've got either just paid their tax bill or they're calculating their tax bill, and it's on the subject of how you should incorporate, or should you buy another property, would you buy it as an individual or sorry, I thought I was dropped out then, but he's still there. I was let me just go back to those. So essentially, we've got the choices are buying an individual or buying through a company, and there is actually also a transition between them both. So essentially, the rule of thumb is you basically got the personal tax rates, which are going to be the main driver for a lot of people. So you have personal tax rates where you've got a personal allowance, and for companies you don't have a personal allowance, but for individuals you've got tax rates of 20 rising up to 40 and 45%, and for your company you've got tax rates of 19% currently. That's on the income. You should also look at the capital, and currently the capital gains tax for the individual is either 18 or 28% if you're basic or higher rate tax, and for a company it still sits within the same tax rate as the company itself at 19%. So the individual rate is higher, but that's not the sole story behind it. With section 24, an allowable interest, and that essentially means is that in a very simple is that the interest that you're having deducted against your investment is no longer fully deducted against the income, and that's for an individual, but for a company what gets set off against it is to ensure that the connection, sorry, I've got a warning to say it's unstable, so do apologize if I drop out. So the the interest is therefore not fully relieved if it is in a personal ownership. I won't go through the sort of the laboratories behind the tax rates themselves, because it's a complicated area. You have various reliefs that can be set off, and you've got things that are unrelieved then get set off against future years potentially. But in a nutshell, it's less attractive being in an individual and having that income. Now, obviously, not everyone will be at high rate tax, and therefore there will be some advantage for people that have rental incomes which fall below the threshold still to be within that, because they A, get the personal allowance, and B, they'll obviously have no effect on their interest financial charge being deducted. We also should just talk about the in in rule of thumb, the individual's going to be working out more expensive, the company's going to be working out cheaper. Now, how we get from one to the other, if you've already got your property owned in an individual, I'll talk about briefly later on. In itself, it can be quite a complicated area, but I want to just cover the other aspects on the which is the stamp duty. Years ago, it was literally 5 shillings or whatever it is on the change of a property. In the same way, from these days to the change of shares. But of course, this transaction tax is quite expensive for most investors, and I wanted to highlight to both individuals and companies as well, because what you may find is that there is a heavy premium being payable if your property you're buying has a certain value. So there is a rate of stamp duty which you will pay regardless on the actual transactional value itself, and then obviously there's an additional to that, you've also got a premium which you pay, which is for a second home or a company. So that is adding an extra level of tax to your transaction. Now, for a lot of people, that's not necessarily too challenging to pay if it's on the lower values, but I'll just run through an examples of the values. So less than 125,000, both the individual and the company have 0 to pay. On 125 to 250, you've got 1% to pay, and the same thing applies to the company. And also for 250 to 500,000, it's 3%, which again, the same thing applies to the company. However, with a company, you're then going for £500,000 to £1 million. The rate goes from 4 as an individual to 15%. So if we've got some expensive properties out there, less attractive, and the same 15% goes throughout the figure after that. So certainly from a individual's point of view, for expensive properties, the company may be less appealing. So it's all a question of how it's all going to be structured. There is quite a little bit of stamp duty, not that when you're talking about multiple properties, but a lot of those reliefs have been limited. There's one other area to talk about on this. There's what's known as an annual tax on enveloped dwellings. So essentially, there is an additional annual charge applied to certain valuable properties, which are above £2 million. Not many people are going to be in that category, but I thought I'd just mention it as a potential. So as my worksheet that I've prepared then goes through the different calculations behind how rental income will work, and I'll just cover some examples to where you can then fit, or where you see your clients fitting in this. So there's a case study which has a £25,000 rental income, so not too difficult for a person called Christopher who lives in East London. He has his personal to come off. He has no other income. He has 12.5 therefore is taxable on. At his prevailing tax rate, he's got £2,500 to pay. So if he was to incorporate his company, it wouldn't be a very good decision, because he would have no allowances. And let's say for now that the 19% is 20% in a few days' time, which it may well be a lot higher. With no relief, no personal relief, means he's going to be paying tax at £5,000. So he's doubled his tax bill as a result of that. So not a great decision. He's also got the cost of setting up the company, and he's going to probably, if he was told by a mate to set up a company, he's probably been a bit miffed for that. He's also, don't forget, probably had higher interest charges. So with a company, you do have higher interest that's going to be payable. So another example then is Kieran, who's a higher rate taxpayer, and he runs an environmental services company. His income from the properties is 25,000, just like Christopher was. He earns £70,000 from his environmental management job. Now, if he was to own it personally, he would have 25% at 40%, which would be £10,000 payable. However, if he put it into his limited company and he would not take that drawings out, then again, assuming it's 20% for simplicity, 25,000 is going to give him that £5,000 tax bill. So in that case, he's actually halved his tax bill from having a company. So in the case of Kieran and Christopher, it all depends on what is your background income, but otherwise the same criteria was. One could actually halve their tax rate, the other is actually double the amount payable. So it can be, quite an important consideration to make. We obviously got stamp duty, so we got capital gains tax, which is invariably going to be changing, but currently it has been very favourable to owning it in personal names, 18 and 28% versus the income that you'd draw out. It's fair to say that the company would actually have lower tax rates at 19, or what will be slightly higher than that in the next, no doubt, the next few weeks. However, you've also got to draw out that money to in the form of dividends. So if you're drawing out in the same year with dividend tax and higher rate tax, then you're going to be at a higher threshold than you would do if you had it personally owned. So a big part of this planning is, what are you going to be doing with the money if you had it, or your clients have that money to go on to. So there's also a variety of GDG capital gains tax reliefs. So for example, they could be looking to move into the property, which you don't have the option for a company. Plus, and that could be, one time it's worth 3 years. Unfortunately now it's not worth a great deal benefit, but it's still a benefit to be had. So you get the actual period of being occupied, and what used to be an additional 3 years bonus, now it's down to 9 months criteria there. So we have and also you have lettings relief, so that the fact that you've owned it and you lived in it and you've also let it out, there's also an additional relief that's available. Now, of course, these reliefs could be disappearing with the sort of catch up for everyone to be paying for the COVID expense that the chancellors had to fork out for, including nice meals that we had in the last summer. So that is my sort of formal part to the presentation today. I will happily take further questions of any nature on this subject or anything similar in the form of property tax and anything else that someone may be affected by. There are other considerations why companies would be favourable. I mentioned earlier why interest rates are higher for companies, and a lot of people are saying, I'm not going to do it because of the company, because of the extra forking out of a mortgage. It's fair to say that those rates are now quite similar, and you certainly get better deals as an individual. And it is possible on the purchase of the property, or a few days later or a few weeks later, to do what's seen as a deed of trust. And in that deed of trust, you basically say, although I've bought it in my own name, I'm going to be treating this as a company purchase. In the same way, I mean, we're very fortunate in this country compared to most other countries, certainly across Eastern Europe, that if you don't have a piece of paper that has your company name on it, then you're absolutely stuffed as far as allowing it for their tax authority, and it has to be stamped at the local tax office. These systems are not quite archaic for British standards, but we're fairly fortunate that if you did buy something which is for the company's benefit, you can be completely exempt from that falling under your own tax position. So there is a way of getting it in the company, but still having the lower mortgage rate, which is an attractive way that a lot of my clients are doing it. So this idea of saying, oh, don't give the company you're paying an extra 1.5% rate of interest isn't quite strictly the case, and you can avoid, and you will avoid, capital gains tax when you come to dispose of that company, because you dispose of that property, because you have proven that it has been throughout that period treated as a company asset. Okay, so if there is a little hands up function on this, if people want to put that up, or a reaction, I think there's you can do a reaction, thumbs up, or if you want to raise your hand, if you like, to just any questions that you have, or for Mike, how did you find that?
So I thought Sam raised his hand, didn't he?
Thank you, Mike, ever the gentleman. Thank you so much.
Yeah.
I did a clap and a hand raise, so
Yeah.
Thanks, Colin. Colin, I don't know if it was me, but the connection was a bit glitchy at the point where you mentioned something around 14%. I didn't know what that was related to, but I wondered if you could clarify.
I had the warning coming up to say my signal's going poor, and luckily.
Right. Thank you so much, and thanks
died
again,
on me
Mike.
completely. So in terms of the discussion on the 14%, I probably with it was 15%, which is the applicable rate for an expensive property. So if you're buying an expensive property, then there is a company rate which is much higher than as an individual. Which
okay, and what is classed as an expensive property? Is it in value terms? I presume, right?
Yes. Yeah. Exactly. Yeah. It used to be £2 million. They brought it down to £500,000.
Okay. Wallet doesn't stretch that far. Thank you. Okay, I get it. Thank you.
No.
Thank you.
Yeah. Cool. And then we've got another hand up. So, Cumney, could you like to ask a question?
Thank you very much for the knowledge so far. It's been very insightful. I would like to ask a question in regards to, so I'm just in the process of sorting out my compliance to set up like a management company for rent-to-rent properties. But I was wondering, for myself, I am looking to buy houses in the future. Would you recommend me potentially buying my initial property under the company, or would you say maybe the first 1 or 2 houses to first buy my own name due to tax reasons?
Yes, so you benefit from having being a first-time buyer as an individual for your own home, but you can use that on whichever purchase you wish to do. So it may be more attractive for you to have it against the more expensive property if you were to choice of buying it, buying yourself. But your rent-to-rent deals, then that's a trading activity. You have with, as mentioned earlier, high rate taxes, which if you structure it well, you can actually put your business activities into the limited company. You can claim various allowances, and you can structure your drawing, which is known as a dividend for a company, based on your tax rates that are applicable at the time. And that may then mean you can structure your withdrawal on a beneficial basis. But so yeah, it wouldn't, running it through your own name. It very much depends on what other income you're going to be making, and what you consider to be a realistic income that this new source is going to be bringing in. I mean, there's obviously, without going through the detail now, there are considerations there to be made.
Thank you.
Cool. Okay, just want to get some. Anyone else? Just want to see if anyone else joined us. Yeah. Yeah. Bala, do you like to?
Yeah. A couple of things, Colin. Could you explain deed of trust, number one, and also what kind of limited companies would you set up to buy a buy-to-let property or a HMO? Is it LLP or LP?
Yeah, and so I was going to cover the actually second part to the thing. So yeah, sorry, your first question again is what's the deed of trust. So effectively, a deed of trust is essentially a piece of paper. It can be as simple as almost a letter of intention between two parties. They're very rarely more than 1 page long, so they're not a difficult document to understand, to comprehend, and thankfully the tax office also haven't found them difficult to understand, although you do find clearly the uninitiated on an inquiry may be a bit puzzled to say, how come someone's got all these properties and yet they're showing a rental income of 0 or rental income of this figure? Yeah, invariably it can spark a lot of fury unnecessarily. And also, unfortunately, finance companies don't really understand it, and they don't really want to. So if they see that somebody has bought properties in their own name, but it's put through the company, we've been luckily on most of our clients, they've been fine. But I know personally, every time we present something outside the norm, they just don't like it. And so banks, unfortunately, have got certain boxes and certain ticks, and if they outside those boxes, they don't really tend to like it, and confusion can be a bad thing when you want to obviously try and borrow money from a bank. So okay. Yeah, so in short, they're not a difficult document to produce. We produce them, for example, because we have clients that have properties in own name that want them to be joint with another person. That could be their marital partner, it could be any other person, it could be that they own it jointly and actually they want to have it as an individual ownership, or they may want to have any combination of a share being different. So it enables you to have a difference between what is in title, i.e. what is if you were to go up and look up the land registry, who is the owner of that property, you'll have the answer to that on that land registry document, but that doesn't say to you that person can give their allowance, their trust, to say, I would like it to be treated on a disposal or on a rental or any basis that they wish, to have it on a different basis to what the initial one was. The title gives that person entitlement to, and it can also mean that they can also withdraw that beneficial interest at any point in time as well. So it has it's a bare trust, but it gives people an advantage to play with there. And the next point you mentioned is, which is the biggest part of my client base, and indeed myself are going through, is that we would go from people who've got individual properties owned as in individuals, and so they did that right for the time. They possibly realised that there was not any fundamental difference. There was certainly been higher income tax payable at the time, but maybe there wasn't foreseen as to be a big income at the time. They've grown and they continued, and probably they've grown and own property in individual names, because the abundance of mortgages for owner occupier for individuals with buy-to-lets is phenomenally longer than available loans in a company. Now things are changing, and you still get the more challenger banks, the ones that are offering the people like myself, possibly slightly higher risk categories, have always treated limited and non-limited pretty much the same. But you've got the very conservative lenders like the Nationwide, that goes under the banner of the Mortgage Works, and many others that have different banners behind that. They go for the much lower risk category, so they typically go for people with relatively fewer investments, or have a cap of say £1 million, etc. borrowing. Or sometimes they have a cap of 3 properties. So all those, the more conservative lenders won't either offer limited companies or will have a much bigger premium for that. So that is why individuals have got the properties in their name, and they've just carried on regardless, recording it as their own income, rather than possibly getting advice at the beginning. Certainly as soon as Article 24 came in, when interest is now being restricted, we're now in a position where it's quite attractive to put it into a limited company. So that would therefore be an option. So in order to move it, if you have got it and have counted for it in tax, as an individual's name. You will have an ability of avoiding capital gains tax, avoiding stamp duty by shifting into a company. Now, if you did it straight away, unfortunately, you've got those two taxes to account for. Cleverer people than me that look at tax laws, legislation, law, some very clear tax lawyers have, and it's around the internet for some years now, have proposed that by incorporating it into some business, which can include a partnership or include a limited liability partnership, from a tax point of view, they are treated the same, although legally there is a difference. We don't need to go through the detail right now. But if you had that for a period of 2 years, there is a deemed business operation to this activity. And then by shifting that then into a company, then you avoid on both those transitions. Both those transitions can happen with a deed of trust, or you can incorporate it into a title change. It can avoid capital gains tax and avoid stamp duty, which of course would otherwise prohibit the benefit to this happening. So that's an opportunity for people to have. And Sam, you had your hand up and you took it down again. Did you want to just come back to me on that?
Yeah, I think you were answering it as the question was sort of happening in my head. So I'm in that situation as an individual, and I'd like to move the property into a limited company as I'm looking to acquire more properties in a limited company. So I probably fall into that bracket. Yeah. And of course, just making sure that I can take all the information in. But it may be a detailed one for this session, but if it's okay, I could reach out later on if that's okay, just to sort of ask some more detailed questions specific to my situation, if that's okay, Colin.
Yeah, absolutely. That's fantastic.
Okay, brilliant. Okay. Thanks.
Has anyone got any further questions? So, okay, that's good. Well, thank you all for joining. I would, hope that we can join me for future sessions. And if you would like to just provide your feedback to me on either an email or a message or something, that will be really helpful, because I'll be able to use that for future marketing for events like this, and it keeps me going. So thank you very much for joining. And anyone else got any more questions? If they have, then feel free to ask them to me personally. On email is the easiest, but there's other ways of getting hold of me. I'm sure you'll work it out. So cool. Thank you very much, everybody.
Did you say
Thank you very much.
Did you say you'd be sending it a link? Sorry, Colin.